Good afternoon, everybody, and welcome to this edition of Hardman Talks. My name is Mark Thomas, and I'm Head of Investment Companies here at Hardman Co. Today, we have an open session called Everything You Wanted to Know About Private Equity, but were afraid to ask. With companies staying private for longer, and with private equity becoming an increasing proportion of most institutional investors' allocations, we thought we'd give our audience the opportunity to dive into this increasingly important area and discuss some of the concerns and maybe some of the misconceptions that get into the press headlines. It's intended to be a very interactive session. We've had a number of questions submitted already. From these, we'll be covering areas like how does PE make money, fees, valuations, leverage, the impact on employees, as well as managing the discount. I'm delighted to be joined today in the bear pit, so to speak, by Stephen Tredgett, a partner at Oakley Capital, who has bravely agreed to a no-holds-barred discussion that tackles head-on all the awkward questions and the negative perceptions about private equity. We are very grateful he's promised to open up in good faith on any topic, so don't be shy in asking questions. Just as a reminder, Oakley Capital is a Europe-focused private equity manager, whilst Oakley Capital Investments, or OCI, is the liquid listed vehicle that has investments in Oakley Capital funds and managed assets. So, into the breach, dear friends, and on to our first questions. How does private equity make money these days for its investors?
Well, hi, Mark, and thanks for having me on, and thanks for those that have joined us. No one mentioned this was a bear pit, I had to say, but here goes. So how does private equity make money for investors? I think the first thing is let's talk about kind of structure. So we raise funds, and these are raised kind of in chronological order. So you kind of raise a fund, you invest it, you harvest it, and then you raise the next one. And so typically a fund will have a 10-year life. We invest the funds over a 5-year period, and then we harvest those investments over the following 5 years. So a traditional investor in a private equity fund will actually commit to it over a 10-year period. There's nothing kind of surprising about the high-level way in which we make money. It's in investing in the equity in private companies at a certain level and selling it at a higher level over growing that business, and usually over a holding period of 3 to 5 years. I think the kind of key points are around origination, as it can take kind of many years for us to kind of identify certain opportunities, get to know management teams, cultivate a relationship before making investments. Some opportunities come to us and can have a very short lead time into investment, but there's a big variety, and as we'll no doubt touch on, we look at a lot of opportunities before we make investments. And then there's kind of the valuation, the value creation kind of throughout the life of the ownership, and that comes in the form of, for us, it's specialisms like M&A, digitalization, marketing, internationalization, to help produce kind of fast, consistently growing businesses. The average EBITDA growth of our companies is 35%. It's that EBITDA growth that we rely on to kind of create an increase in value in the companies. So when we sell them, we're selling these assets for 2, 3, 4, at the most. I think our highest multiple we've achieved in investment is 15 times. But we're looking to kind of come in around that 3-4 times money multiple, and the funds that are realized return to the investors kind of thereafter.
We started off with a relatively soft question, so we now get into the bear pit proper. Private equity charges what to many is an eye-watering performance fee, and some academics have argued that in the US, all the supernormal returns have been swallowed up by the manager's fees. So how do you justify such a payment? And whilst we're on fees, there's a second question, which is, how can managers charge the fees they do when the world of investing and fees has come down so substantially in the past decade?
I think the first thing is to acknowledge, where people see the disconnect, which is that, and let's be frank about this, a typical private equity fund charges its investors a 2% management fee and a 20% performance fee. Now, those, as funds grow in size, you typically see particularly the performance fee, come down as you get more economies of scale with larger funds. But still, private equity will charge somewhere in the region of 1 to 2% management fees and somewhere in the region of 15 to 20% performance fees. I think actually the erosion of performance that is referred to within the US is actually a slightly different issue, and that comes around quality of managers. With bit more available funds, you get a wider pool of managers and you get a bigger spread of performance, as will come out in a range of these questions. To define private equity in one question or one response is kind of missing the point. It's a very diverse sector with a range of different kind of private equity strategies. Some are very long term, investing in very big assets, and their returns are a lot lower than, say, for example, which ultimately, kind of PE, that's a lot of capital goes into that area of the market. Whereas if you move down to the higher risk VC end, the returns are far from diluting, but you take on more risk down that end of the market. So sorry, kind of tackling the first kind of question, kind of management fee and performance fee. So management fee, what's the justification for that kind of that 1.5, 2% management fee? And I think it comes in kind of three areas for me. One is simply in that origination that I refer to, in that you need a significantly sized team with a significant amount of in-industry experience or investment experience, screening and contacting and speaking to a lot of companies, and in our case, maintaining a lot of close relationships with entrepreneurs and business founders to source opportunities. And in our pipeline at the moment is some 150 opportunities. The fact is that from that will come a very small number. We probably reject 9 in 10 opportunities that we work alongside. So there is a lot of time, energy, and costs that's committed into finding the opportunities that we ultimately invest in, and we're not unusual within the kind of PE industry.
I mean, as an analyst, I mean, a couple of things, having looked at that report, I thought they were quite interesting. One is a very clear acknowledgement that the PE business model delivers superior returns. The second was it was focused on the US, and the less mature markets around the world, such as Europe, still provide the supernormal returns. And the third, just touching on Steve's point, was really PE is a very diverse animal. And if you break down the sort of the mega funds, they are working on a different economics than those PE businesses which are working in the middle market. And as always, there's the statistics, lies and damn statistics, and if depending which benchmark you benchmark things again, you'll get very different performance.
I think the other key kind of point to then transition onto there, Mark, is around kind of, well, one, there is the structuring of the investment itself. Unlike maybe a public market where you don't have to create the entity which you invest in, you don't have to build the balance sheet and the capital structure, you don't have to put the accounting in, the management information, all that's required to basically build an investment. That is something that takes a lot of cost and time to put these things together. And then, and probably the more significant of the 3 points, is the level of engagement and involvement and the size of the teams that are deployed to kind of manage these investments. Now, I can't speak for every single PE manager, but if you take us as an example, we're putting teams together of 4 to 6 investment individuals on any one portfolio company, a number of whom will sit on the board. There is constant and consistent engagement with the managers and the operating team of that company in order to work with them to develop and grow that business. And this is not contact with your CEO and COO a couple of times a year, as it might be in the public market. This is potentially a couple of times a week. It's a very different relationship, and again, a very different cost basis for which you kind of operate and manage the funds and the investments. And then I guess to point out the obvious, where there has been a lot more fee compression is in other asset classes, and the most obvious is public markets. And I would suggest there that there is a relatively finite number of opportunities. They're all there listed with all the information available to them. the economies are such that one talented individual could very easily manage a multi-billion fund without too much in the way of, fund management or analysis support. Now, different public equity managers will operate differently, but you certainly don't need the level of investment teams and the level of cost associated with it, for all the reasons I've just identified. Even in the most active of public equity managers, the active level of it is relatively soft engagement with the management teams. There is a limit to what you can affect as one shareholder amongst many, and rarely do they sit on the boards. There are clearly exceptions to any of this, but rarely do they sit on the boards of those companies.
So basically, a high cost to deliver the high return.
Well, and then we should talk about the performance fee. I mean, so on the performance fee, I guess there's one thing to note is the hurdle. I mean, the hurdle of 8% does not exist on any other asset class. Most have come down with the cost of capital, particularly in terms of debt and in the public markets. But private equity is retained at that level. So nothing is accrued to the manager. And the other thing is that is the main kind of aligns. That's the main source of reward to the manager. It aligns you completely with the manager. I'm almost surprised that public equity funds don't have, I sometimes see that most of their reward comes on a management fee, which they're going to get come what may. I mean, you think it would be, make it all performance fee and give them a hurdle. Otherwise, where are you aligned if you're just getting, kind of paid to manage? So I think you're incredibly aligned. And also what it does is continues to attract the best minds and the best talent. I've clearly slipped through that net, but the best talent is drawn to private equity as a result. And in other industries, you've seen a brain drain away from certain industries. So you also get what you pay for.
Brilliant. Next question is, how sustainable is a PE business model which buys a group, then sells off the best companies and makes returns on the weaker businesses by loading them with more debt? And sort of related to that is that still the business model?
Look, there are of course examples where PE-owned companies have been broken up, or companies have failed under the weight of debt. And this has happened over history, and it's happened to both public and kind of private equity backed companies. I think it's the kind of first point to make, and I think neither are typical characteristics of a PE deal. I mean, looking at both in turn, I mean, the asset stripping, breaking up of companies to unlock value through kind of the realization of the sum of parts is, I would suggest, the kind of practice associated with kind of vulture funds in the 80s, and it's rarely seen today. And it's the natural source of frustration for kind of individuals from within the private equity industry who are almost sheepish about admitting that they are within PE, because that's still the perception of the industry, which is incredibly far from the truth. I mean, on the subject of the kind of breakup, I mean, actually, as it happens, there is an increasing trend for conglomerates to break themselves up at the moment. And this is just as prevalent in the global publicly listed space. I mean, with companies like Siemens, for example, who are focusing their operations to realize value. Now, this gains a lot less attention for a whole raft of reasons, but principally because their management or ownership hasn't changed of Siemens, for example. But typically, if it's happened within a private equity company, the management or the ownership will have changed, and it's PE. So on the rare times it does happen, it really gets the focus of the press. The other point around the kind of heavily debt-laden companies, I mean, once again, there are examples of companies collapsing under a weight of indebtedness, and they have happened within the public and private arena. I mean, for every Debenhams in private equity ownership, there's a Carillion in the public market. I think the greater point here is that the debt level applied to any of these companies would have been appropriate given the outlook of these companies. And remember, there's also a debt manager who would have had to have, made the decision that this was an appropriate debt investment, for a debt fund. This is not at the whim of PE managers how much debt, a company doesn't have. They're clearly going to have, a view and an intention as they build a capital structure, but I'd make that slight, kind of nuance. The problem in these cases is not necessarily the level of debt. It's the fact that these were poorly managed on failing business models. Now that's on the PE manager that made those investments, and it's on the management that they back. And regardless of ownership and structure, those companies, would have struggled or potentially failed. That happens. Unfortunately, businesses, fail, regardless of their ownership. And I would suggest whoever you're, whether you're backing a public equity trust or a private equity trust, you have to choose your manager appropriately. I mean, the headline, number for global private equity indebtedness, the average net debt to EBITDA is about 7 times. Now that on the surface of it sounds like a very high number. I don't know exactly, but I suspect that, you don't see many public companies carrying much beyond 2 times net debt to EBITDA. So the immediate and understandable assumption is there is way more indebtedness. It's way more part of the performance, the generation of, kind of performance, and it's financial engineering on the basis of that. The thing that I would say is 7 times net debt to EBITDA is a completely meaningless number without context. 7 times what, 7 times what kind of company, what size of company, what quality of earnings. For a cyclical, low growth company, it's way too high. And one size doesn't fit all. For a company that's doubling its earnings on an annual basis, it has very little in the way of kind of capital expenditure, asset-light business, quick to convert EBITDA to cash, it's an entirely appropriate debt multiple because essentially it'll be paid down inside 3 years. And of course, for PE, the industry typically indexes towards new economy, digital, fast-growing businesses. I mean, if you look at some of the kind of BBC stat, I mean, 90% of the PE-backed investments in 2019 were small and medium-sized companies. So kind of fast-growing businesses, that will have had, kind of quite, visible earnings driven by kind of, structural tailwinds. These are growth businesses.
Yeah, I mean, the bottom line for me is I look at the NAV performance through the early 90s recession, through every downturn, through COVID-19, and PE as a market has outperformed. Yeah, if the debt gearing was inappropriate, yeah, the NAV would perform worse than public markets. So yeah, I see sort of proof of the pudding, so to speak, in that particular one. Just moving on to the next one, slightly different topic. The press seems to love to quote examples where private equity-backed companies have failed, leading to massive unemployment and leaving pensioners with their pensions at risk. How do you see private equity impacting on employees?
Yeah, I mean, I think the first thing is, I think it's worth it kind of acknowledging the sins of the past PE is that there hasn't, I mean, I go back to that kind of original, kind of approach to, smashing businesses together, ripping out costs, that kind of vulture reputation of PE, and not every PE investment is going to, kind of create jobs and be successful. And of course, as we've acknowledged before, some fail and public ones fail as well. I think the reality, though, is it's just so far from that kind of perception, and you don't hear so much of the success stories and the job creation points, which far outweigh the kind of failed businesses where kind of jobs were lost, and particularly in kind of employee intense areas, like for example kind of retail with big kind of retail networks, an industry which of course is struggling across the board, regardless of their ownership. I mean, the fact, if I look at some of the kind of BVCA data, there's 4,300 PE-owned companies in the UK, and they support some 1 million jobs, and it's a job number that has been rising kind of year on year. I mean, I only have the kind of Oakley stats to hand, and we're a tiny drop in that ocean, but kind of we have something like 22 portfolio companies today. And last year, the net job creation was about 350 jobs. But we're far from special. And I guess on a kind of an economic basis, I mean, P and VC owned businesses collectively contributed about 20 billion to UK GDP in kind of 2018, 2019. And also, I mean, UK particularly, and this is something that I think is hopefully something that we kind of learn to celebrate, is kind of leading the way in certain areas, particularly in terms of technology champions. I mean, VC investment in this area is being increasingly focused on UK. We have more unicorns created here in the UK than in anywhere in Europe. Cambridge has now been identified by Atomica report as being Europe's unicorn capital. The UK is seen as kind of VC and technology, the biggest VC and technology hub outside of kind of America and West Coast and New York. And some $100 billion has been invested in the kind of European tech industry over the last year alone. I mean, that to me, at least the lens that I look through, is more the reality of private equity investing and the investing in kind of a new economy and the creation of jobs in a fast-growing new economy.
Yeah, I mean, there was an interesting Europe Invest report, which highlighted that the growth in Europe was in PE-backed companies was significantly ahead of public companies, other private companies, and even the state. So in terms of employees, the growth numbers are there. And the bottom line is that if PE backed lots of businesses which failed, it wouldn't have the superior NAV return. So almost by definition, you're getting the NAV return is evidence of stability and support for the employees. So just moving on to the next one. Many listed private equity vehicles say that when they're evaluating new projects, they assume they will be selling on lower valuation ratings than in the market today. How can we have confidence in net asset values, which are based off current ratings, given this, and when there is limited transparency on how private equity actually values its investments?
I think just to kind of address the first point is, kind of why PE assumes, or there's examples where private equity managers say they assume a lower exit multiple than entry multiple. I think it's more an exercise of saying our investment strategy or investment thesis is not based upon multiple expansion, because that and all the market rating for companies is something that a private equity owner, like any owner, has less control over. What they have control over is kind of how a company grows, the levers to pull to kind of increase that growth. And that's the basis that they make an investment. And assume the worst, that you may or may not get a lower multiple on expansion. Now, the reality is far different from that, but it's kind of an act of conservatism in basically saying, I can't assume that we can buy at a low multiple, sell at a high multiple. Could you imagine if the public markets kind of said, actually, I'm a value investor, but I can never assume I'm going to buy at a high multiple. The whole premise is that they believe the market will rate it, but there's no guarantee, and you can be the classic kind of response that the market can remain wrong longer than you can remain right, and there's a little bit of that kind of mentality, I think, in that statement. Now, our view on multiples is that you really only have visibility of the pricing of a private asset at the point when you buy it and the point when you sell it. And so consequently, in between, there's no doubt going to be multiple expansion as you grow the asset, improve the quality of the earnings, maybe introduce a subscription element to the business. There's naturally a reason, scale, whatever it is, prevailing kind of peer group multiples. You'll see a creep in the multiple, but it's relatively modest. And to kind of demonstrate where I think you can have faith in private equity NAVs is in two. I'm going to give three factors. first off, it's third party audited at least once a year. So you're not just reliant upon the private equity manager deciding what they value their own assets at, and that is a finger in the air. Secondly, I think just from an understanding that there is very little motivation for a private equity manager to overvalue an asset they own, principally for the reason that there's no incentive. The management fee doesn't increase, performance fee doesn't increase. They are only going to get a performance fee on the basis of what the asset's sold at. What it was held at throughout the life of the holding period is largely irrelevant, to the kind of performance and incentives of the private equity manager. And then finally, and probably most importantly, I guess the proof of the pudding is in the exit. Now, I'm going to give the Oakley stats here, but it is broadly the same for the kind of our listed peers. I mean, whenever we sell an asset, since our inception in 2007 was the first launch of the first fund, every asset's been sold then has been sold at an average of 44% above where we were currently holding at that time on the books. Now, actually, in 2019, the premium was something closer to 90%. I mean, I would argue the kind of question mark should be, hang on a minute, we're not alone in this. Is PE too conservative in the valuations? I mean, our half-year results, the question I faced for OCI, the question I faced more than any other, particularly from analysts, is your average EBITDA growth is 25%. The average holding value of those companies at the moment you've got is 12 and a bit times. It's like, how? What does that tell me? Is it slightly implies that these might be slightly lower quality companies? Like, how are you holding companies with that faster growth in the kind of sectors that we're in, like technology, consumer digital, ed tech? How is it that you've got companies at that valuation? Well, it speaks to the fact that we get in at relatively low valuations, and we are pretty modest in our uplifts of valuations while we're holding them. Now, I can't speak for everyone's kind of multiples, but let's look at someone completely. Look at HG. They're investing in kind of high quality, large European software companies producing solutions for small medium businesses. Their average multiples are kind of 20 odd times. Why? Because these are the industry leading sector champions in their particular space, and the runway for growth for these companies is enormous, and a clear kind of secular structural growth that will drive these businesses for many years. And consequently, HG would tell you can be kind of comfortable with the multiples and they hold those companies at. So I think increasingly over time, and look, we need to do our part as well. The more information we provide about the portfolio, the more regularly we update on our NAV, the more confident I think investors will become about the NAV, and then the shares will trade kind of closer to or above that mark. I mean, to that point, we're moving in Q1.
I think you're being unusually modest in the sense, I would say market wide, it's maybe 30 to 35% uplift on sale as opposed to your over 40%. We've got a sort of related question around valuation, which has come in live. Yeah. Are you concerned by the gradual increase in valuation that deals are being completed at? How are you mitigating the increase in valuations on new transactions?
Yeah, I mean, the question is absolutely right in that if you look at kind of, I think there was a Bain report talking about average entry valuations over the year are up 20%. So from 10 times EV/EBITDA to 12 and a bit times. So clearly, I mean, what's at work there? I mean, clearly that's across all PE investments. So we've, kind of, I suspect as you see more investments within PE are typically made, as we've already highlighted, on digitally enabled, tech-enabled businesses. Well, fun enough, they are at higher multiples, so you're going to see some accretion. There clearly is more capital being deployed in the world of private equity. So again, and of course, you're seeing companies, that may have listed for higher multiples on the public markets, choosing to remain private because capital is available and at appropriate valuations. Does it concern us, and how do we mitigate it? I think you'd be naive if you weren't just naturally kind of concerned about your ability to continue to source high quality assets at the right prices. I mean, that should be the one thing you worry about as a PE firm, kind of day and night. How do we mitigate it? I mean, our sourcing is what we consider to be, our single biggest differentiator. So in the case of Oakley, we were founded by an entrepreneur who basically, bemoaned the quality of the financial partners that he had on offer, throughout his kind of, lifespan of kind of building and growing businesses. And the reason being, he felt, was that no one really understood what it was like to be an entrepreneur. No one understood the support you needed. It was cookie cutter, one size fits all, businesses that were, started and run by business professionals, lawyers, accountants, industry professionals from financial services. And so with that kind of simple kind of mandate, of kind of relationship-led investing, kind of focusing on the needs of our entrepreneur partners, we've been very fortunate. I mean, much has changed about Oakley and our size and institutionalization, but that DNA of focusing on the business founder has been incredibly valuable to us. So we've now backed over 20 of these founders. Of course, the great thing about an entrepreneur, they don't just stop, they don't just do one company, they're serially successful. So we're very lucky with the quality of the people we back. They introduce us to other entrepreneurs. They invest in our funds. Nearly 200 million euros of the funds that we manage are invested by the founders we back. And what is typically the case with a business founder is, they're naturally nervous about allowing in, kind of private equity for the first time. They will be in no way prepared, their business, for private equity. It can go through a typical kind of auction process. They've probably been dragged slightly into the administrative weeds. They really have aspirations to kind of grow through M&A, internationalization. And so we have to get our hands messy. I mean, we are, in 90% of cases, we're the first private equity backing a company. 75% of cases, they are proprietary. It's just us trying to work out, how to kind of, to make an investment. The messiness of no management information, awkward shareholder structures, no formal accounting, we think, our willingness to embrace that and basically navigate the risk that comes with it means that we get in at really interesting multiples. Our average entry multiple, actually since inception and for Fund 4 and recent fund, is about 9.4 times.
Yeah, I think the point about business mix is hugely important. The next one, I'm going to say this tongue in cheek, just requires a simple one-word answer. Please confirm you meant your performance fee only kicks in when you sell a company and it's never related to stated NAV.
Yes.
There you go. We've got a question about PE firms raising billions of pounds they need to deploy. Yeah, many companies crowding into a small number of hot sectors. Is this creating a bubble? I think you probably answered that with your last question.
The only thing I would say on that particular question, Mark, is that, I mean, yes, I mean the FT quotes, what is it, $2.5 trillion of dry powder. I mean, that's funds sitting within private equity funds that have yet to be deployed. And that is at an all-time high. And so naturally the question is like, holy smokes, that's a lot of capital coming. And that's clearly going to drive it. It goes to the other question. I recognize that there are a couple of things I would say on that. One is the private equity, as much that's talked about it, and the size of the kind of level of capital drawn in, entirely drawn in by the performance of the asset class, it's still not a massive asset class. I mean, Mark, you may know the number better than me, but it's 10 to 15% of global assets. It's not huge, and it's certainly, the equivalent in global public equity around the world is higher. Would be the first point. The second point is the kind of, I think the number to look to is how quickly that capital is being deployed. I think typically over time, it's roughly taken on average about 2.5 years for the private equity industry to kind of deploy the dry powder that's available at any one time. That number actually has remained relatively stable, if not slightly dipped in recent years, which kind of implies that there are more companies now seeking capital, more companies are growing and being started up, as a result of the fact that more, that capital is available to support them and see them grow. And, kind of consequently, it is less of a concern, I think, generally. It sounds quite a scary stat, but it's not entirely as it appears.
How do you negate the wall of negative sentiment that PE faces?
I mean, that is a great question. I mean, mainstream media, it isn't, and maybe understandably, out to kind of give a, kind of positive or rounded kind of view of private equity. I mean, culturally, particularly here in Britain, we don't really embrace success, particularly individual success and the creation of wealth in financial services and the investment sector. And look, I understand why to some extent, because some of those individuals, are not particularly likable characters. But this is a very wide industry, and you can forgive PE and those very successful and hardworking individuals that have created some of these businesses for not wanting any media attention, because largely it's entirely negative. So you have this unwillingness for PE to address the concerns, and you have a willingness for kind of mainstream media to continue to focus on things that have gone wrong, because PE, always seems that kind of unattainable underworld, unscrutinized for the kind of uber wealthy, and the idea that it's robbing national riches off the public market and putting it in the private world. Now, the truth of that is very different. I mean, for one thing, the financial backers of PE funds are pretty much the same as public market funds. It's pension funds, insurance companies. It's exactly the same money. It's county councils of Northern England are invested in PE funds. So there is not it's far more democratized than it would appear initially. And of course, now that there are listed PE funds, you and I are free to kind of trade in a liquid kind of proxy for private equity performance. The challenge is, look, it's about doing things like this. It's about surfacing the kind of real stories. There are trade groups set up in order to do this. I mean, fortunately, we get way more, you and I get way more retail access now than we've ever got, with 50, 100, 150 individuals, high net worth individuals dialing in, to discussions like this to challenge or better educate or ignore the kind of things we say. That was not happening a year or two ago. And I think if private equity continues on the momentum of proving how well it's coped and traveled through COVID versus the GFC, which I think it's coped, it's positioned itself far better, continue to improve the consistent performance, continue to improve its visibility and communications, continue to engage with a private individual investor community. My belief is over time the perception of this asset class will change, and I suspect in some ways it has. But if we were to sit here and kind of talk about venture capital or growth capital or PE or impact capital or infrastructure or angel investing, the perception of all those would be very different. But because they all sit under this private equity capital, it gets a slightly different perception attached to it.
And it just as a purely personal anecdote, until about 3 years ago, I was only aware of one listed private equity vehicle, as opposed to the, whatever it is, 12, 15, depending how you classify it. And I think the more communication, the more awareness that this isn't just about really, really rich people making more and more money, and that Joe Public can't get into it. I think the communication side of that actually is a really important addresser of the sentiment. Okay, we've got one on ESG. With ESG increasingly important, how do you justify taking companies private and so reducing investor disclosure and scrutiny rather than increasing it?
Look, it's a great question, isn't it? And there's a bit of a paradox here, isn't there? The nature of private, one of the advantages that private equity has is the disclosure. You don't have to private company to disclose as much about yourself and give up your information advantage that you have over your public equity peers, for example. And understandably, that raises concerns around a lack of scrutiny and the kind of, the underworld of PE. I mean, the reality is very different. I first say is that actually we disclose to our investors, as we are, and but also, kind of other PE firms do, increasing amounts of relevant material, particularly around ESG, and now hold ourselves accountable to higher standards of ESG and report KPI. Well, we're starting to collect the data, but many of our peers are already collecting that data and reporting on a raft of ESG statistics to show where we stand currently and if that is improving over time. And I would suggest that actually PE's been a lot quicker to adopt higher standards of kind of ESG monitoring and data gathering and kind of strategies. One of the benefits of being, kind of single owners with relatively long-term time horizons is that we've got the patience and time and we don't mind putting the cost in place to kind of make these changes. Something that I think the average, medium-sized business within the public company really doesn't quite have that same, that same flexibility. And I think the ESG is really focused on, with the bigger investments, with a higher kind of influence over the companies, and maybe the FTSE 100 companies, maybe there, a certain standard of ESG is applied. Whereas as actually you look at PE, the majority of us are signed up to the UN PRI standards. We're reporting under SFDR requirements because funds are being launched at relatively regular intervals. We are introducing more ESG standards and KPIs that we are going to we're signing up to and reporting to our LPs. I think there's also a greater understanding of the value created by sustainability, i.e. that the businesses will operate better and achieve kind of a greater performance by having a kind of wider society impact kind of view. I mean, just within our small number of funds, we've got 2 that are B Corp rated, if that is a standard that's familiar to anyone, and at least 2 others that want to drive for that. I mean, as a percentage of the small number of companies we have, compare that to the public markets, it's significantly different. And although the level of disclosure that you can get on a private equity fund is lower to you, the investor, and we're quite good because we've got a small number of funds. But if you go into certain fund of funds, there could be hundreds or thousands of companies. And so what you can know about each of them is relatively limited. But actually, the information the PE firm has as an investor is way greater than the public markets. Because the scrutiny and the level of the in-depth knowledge of the business is greater. Now, we can't practically surface all that information and put it in the public domain. But I think if you're backing the right kind of managers, there's the knowledge that actually the underlying, kind of transparency is there and the level of engagement is high. And if you look, I think also leading the way are the managers themselves. I mean, if I think about our new hires in the last year, 40% of our new hires in the last year were female. Now, I can't believe there are many financial service, managers or industries where there's been that level of, addressing of the kind of, gender hiring gap.
I mean, a bit of pure self-promotion here. We did a piece about a year ago on the real costs of public versus private, and really focusing on the governance side and saying about, what is the effective governance of public companies? How many of them go off and do stupid acquisitions? How many of them are sacred cows? And that's simply not allowed within a PE environment. So, I would thoroughly recommend everybody look at that report. We're getting questions coming in thick and fast here. So why isn't PE capital used more by companies rather than public listing, when there seems to be so much more time needed to be spent in reporting by managers of public companies, like ESG greenwashing, exclamation mark?
I mean, I think you're as well placed to answer that than me. I mean, I think the question's absolutely right. That's exactly what is happening. More companies are seeking private equity, which is why the number of companies private equity backed is growing faster than public markets, which is shrinking. I mean, it's exactly, the point they make is exactly right.
And I think I'll throw a question. I'd be amazed if you have the answer to this one. Do female portfolio managers generate better PE performance? Still on the ESG subject in the broadest sense.
The stat we have is that more balanced boards have a outperform kind kind of male-dominated boards.
Do you think that discounts to NAV of listed PE like yourselves would narrow if you provided more fundamental information about portfolio holdings, such as their revenue, their growth, EBITDA, debt level, and improve further if you provided valuation multiples and the actual comparatives? Isn't the level of disclosure too low?
Yeah, it's tricky. Look, it's a great question. And it goes back to the kind of the early, kind of paradigm. I think we're getting better as an industry in providing, kind of average, kind of KPIs around, kind of average growth, average multiple, size of investment. We do provide, fair value amount that was vested in, currently, the value that's within that business. I mean, there are a number of sensitivities as we look to, kind of sell an asset in time where we benefit from, not being, so disclosed. There's also another point around how you might view an EBIT, the EBITDA of a business within the public market, and how you might understand reported EBITDA to how you might sell a business in the private equity world based upon run rate or adjusted EBITDA. That's more appropriate. One looks backwards in terms of historical, one looks forward, and there is a danger that you inhibit, your ability to best represent that company when you go to sell it based upon what you might tell the wider market. However, the reason we have in-person capital market days, the reason we bring our CEOs, to events and do kind of private events, which have been harder in a kind of webinar environment, is to provide a little bit more of that detail. In our capital markets events, we try to provide a bit more of that, a greater sense of the underlying EBITDA, a bit more of that information where we know we're targeting it to our OCI investors rather than kind of broadcasting it to the world. So we've tried to kind of tackle that. Of course, we're relatively focused, so we can provide a bit more of that with 22 portfolio companies. It gets harder the bigger you get and the more companies you get with the level of disclosure. But could it disclose it? Could it close the discount more? I mean, the thing is, the more information you provide, the more questions you get asked, the more people kind of doubt what you tell them. The more reasons I give for a discount existing, someone thinks that there's something I'm not telling them. I mean, it slightly spirals. I think fundamentally, the secret to the discount closing is one, continue with performance, consider consistent performance, transparency, more regular updates. These funds get larger in size, get more liquid. Combination of all those things ultimately will close the discount, and has seen by those leading the way, 3i or HG or some of these that now trade consistently at premium, and the market accepts that, and they can grow by the issue of new shares, and they're embraced accordingly. More of us will get into that position. We're just maybe kind of a few years behind in terms of our size, following, and understanding of the manager, and that's absolutely fine. It may take a bit of time. On the discount point, and you're never not going to get me say this, but it's the thing that, look, if you're a new investor, the discount is irrelevant to some extent. I mean, what drives the shares is NAV growth. NAV growth in the majority of cases is driven by EBITDA growth, and that average number is something that we, kind of proudly publish. If an existing investor that has maybe owned, I don't know when you would have bought it, to not be involved in the discount on OCI, and the same with many. Again, performance is less dependent upon whether the shares trade at a discount or premium to the NAV. It's the NAV that is the big driver of performance. The discount is a bit of a red herring, and slightly the commentators shoot themselves in the foot because they constantly talk about whether to buy an investment trust and whether it's trading above or below its long-run discount. If it's at 10% and the discount used to be 20%, you should sell it now. It's like, what? But the NAV's growing at 30%. What? So you kind of perpetuate the discount, getting people to sell the holding when it gets to 10% discount and buy the holding when it gets to the shares when it gets to a 20% discount. And so it kind of creates this kind of vicious circle. In time, one of the problems with narrowing it is that our NAVs are growing, so relatively quickly. Ours grew 26% in the last 12 months. Our shares grew, our share return is about 45% in the last 12 months. but the NAV is growing so fast, we haven't kind of managed to completely catch up. But it reiterates my previous point.
Put a number on that. The discount is about 8 months of NAV's growth as at today. Yeah, that's all the discount is. Yeah, so yeah, say for a long-term investor. Stephen, thank you very much. I think it's been a very open and a very honest session. It's only fair to give you a few minutes to actually say, why is OCI a great investment?
I mean, hopefully, just generally from a PE perspective, hopefully I've demonstrated, the reality of PE investing and value add. I mean, Oakley generally, I think what excites me about Oakley, I think that the sectors it focuses on, kind of the technology side, the software as a service or infrastructure service, it's the consumer digital, investing behind that digital disruption. There are plenty of countries throughout Europe that are nowhere as mature as a UK or a Germany, where there's so much opportunity for that, for kind of internet penetration, and investing behind megatrends that are not going anywhere, regardless of economic cycles or inflation or interest rates, which give us a really kind of insulated kind of investment performance. Whether that is internet adoption, digital solution adoption, the rising demand for high quality education, increasing awareness of consumer health, whatever those kind of drivers are, we're very exposed to them. Technology, consumer digital, and ed tech. Then there's the quality of the companies, its focus. So with that comes risk. It's the sourcing that allows us to kind of get in at really interesting valuations. And here we are coming to the end of another period, which will have proven to be another exciting time for us. Companies have continued to grow at the kind of rate you've become and accustomed to with Oakley, and that in turn is driving the NAV. And next time we update the NAV will be towards the end of January, and also added to that, kind of average holding length of the current portfolio is about 3.5-4 years. That's about our average holding period for any realized company. So I think you can also expect not only a NAV that's continuing to grow, a balance sheet that's relatively strong, a pipeline of exciting opportunities, but also the potential for realizations, which, as we know, can be an exciting driver for NAV, given our history of selling above book.
That's brilliant. Thank you very much indeed. And we will wrap up there. So thank you again, Stephen.
Many thanks.